Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 3rd of April. I'm Daniel Lam, your host for the podcast. I've been getting more feedback over the last couple of days about the primetime TV news program that talked about my chess career, which I mentioned in the podcast this Monday. It made me think about my previous tournaments, and I realized that very often I did quite well when I was not the tournament favorite, or I had much less pressure to win. By analogy, nowadays there's a lot of expectations for US equities to go higher from here. Positioning is at the most crowded level since late 2021, especially for the technology stocks. Forward-looking earnings expectations have moved meaningfully over the past 3 months as a result of significant upward revisions to tech earnings, reflecting an AI earnings premium, but also across many other sectors as well. This creates a high hurdle for lofty expectations to be met during the upcoming earnings season. So is it possible to get any ideas of what the earnings may look like? Well, card spending is a way to get some kind of reading on company revenues. Now, the last couple of months have been challenging for these kind of alternative data sets, largely because of seasonal factors. However, the impact of these seasonal factors tends to fade once we are through January and February, meaning that these data should start to look more reliable. The data, now updated through mid-March, shows that spending has moderated recently, but remains positive on a year-on-year basis. But it is the pace of growth that matters. So the fate of the US equities is still very much reliant upon the technology sector. It is expected to see 20% EPS growth in the first quarter of this year. And there are not many sectors that are annualizing at 20% growth for the first quarter. In terms of positioning, in 6 out of 7 prior occasions when the positioning indicator is so stretched, we have seen unwind and weaker returns following thereafter. So investors should consider fine-tuning their US equities exposure. Now, we upgraded the US energy sector to overweight in our latest global market outlook, and it is an opportunistic buy. We believe it acts as a hedge against sticky inflation and also a potential Trump victory in the US elections. Year to date, the tight global demand and supply for oil is certainly another supporting factor. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.